Hey everyone, Catch Investor back to another video for you today. So in today's video, we're going to go over the Disney Q1 2023 earnings report. For those that joined the live stream where we listened to the earnings call, let me know how that was. For those that missed it, let me know if you want me to do this more in the future with other companies. I would gladly try to do it. Now, I know that live streams are extremely long, so I'll just recap some of the most important points that were mentioned during the earnings call. In this video, we're obviously going to go over the crucial points in this report as well. But in short, they beat on earnings per share, they beat on revenue as well. They came with a, bombshell of an announcement that pending approval of the board, dividends might come back already at the end of this calendar year. It won't be the same dividend as before, which means it will probably be much less. I don't remember how much you were getting before they cut dividend, but we'll take that amount and probably cut it in half or maybe 30% less or something like that. They still expect Disney Plus to be profitable at the end of 2024, which means not the full year, probably just one quarter, probably that end of 2024. Now, my prediction has always been they'll get dividends back when Disney Plus will be profitable. To me, it makes no sense to announce that dividends are coming back before Disney Plus is profitable. But hey, I mean, maybe they needed to announce this to, please some of their investors or some of their older investors out there that bought Disney shares because it had dividend payouts. We'll see what happens. They also announced 7,000 job cuts. They expect $5.5 billion in cost cuts as well, basically savings. They will no longer give us subscriber guidance. They expect $3 billion in saving excluding sports with regards to the streaming business in the next couple of years. Then obviously the question came up when it comes to ESPN, spin-off or not. Right now, the clear answer is no. Then a question came in with regards to ESPN a la carte. This is something they're thinking about, but it won't happen right now. It might happen in the future when they figured out, the pricing of it, how it will impact the bottom line, etc., etc. And then for those that aren't aware, a couple of days ago, there was a report that came out that said, that Disney is exploring licensing films and shows. And basically in this earnings call, Bob Iger basically confirmed that they are thinking about it and it will probably happen. I don't know when, but it will happen, which again makes sense. But then the questions arise and you ask yourself, if they are going to license shows and movies, why should someone go on Disney Plus then if you can watch some of these shows on another platform, which will obviously be one of the competitors? Unless they sell those shows to, just linear players. But those are dinosaurs that won't really be around for a long, long time. So conflicting issues here, but this was to be expected. Now, with regards to the parks, as you will see, the parks perform pretty well. That's obviously because, the prices are extremely high. The demand for the parks are all extremely high as well. Now, they did say that letting more people in doesn't make sense because, it will negatively impact the experience of the park goers because, everything will get packed. There will be lines everywhere. On the other side, they're already taking steps with regards to the pricing of the park experience. We all know how expensive going to Disney parks is. And especially if you take the full package, if you go to the hotel, etc., you want the whole Disney experience, you basically have to sell a liver or two if you want to go there. So they say they're taking steps to reduce those prices or to make it somehow more affordable. I don't know how, but they're also working on making the experience for the park goers more enjoyable. Now, before we jump into this report, if you enjoy this type of videos, do let me know by hitting that thumbs up button, subscribe if you have not, it really, really helps out the channel. And if you want to support me and this channel even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So now we can dive right into this report. So revenue grew 8% year over year to $23.5 billion. Total segment operating income is down 7% to just over $3 billion. We're going to go over these segments a bit deeper in just a bit, but I just want to show you the overview here. When we look at cash used in continuing operations, this has, well, not really improved that much year over year. Free cash flow is still negative. Of course, you have to look at the one here on the left, not the one here on the right. So that decreased 81% as well. Now, when we look at the different segments here, so Disney Media and Entertainment Distribution, that grew just 1% year over year. And like I said, the Disney Parks, Experiences and Products, that performed pretty well. That's up 21% year over year. When you look at operating income, that segment did quite well as well. It's up 25%. Now, with regards to Disney Media and Entertainment, that did not improve at all. We went from $808 million to, well, just under zero. And so you reach a total segment operating income of just over $3 billion, which is down 7%. Now, going even further here in the details, so linear networks keeps on decreasing, not surprising there. Direct to consumer is up 13%. Content sales, licensing and other is up 1%. And if they do really start to license their movies and their shows, expect this number to increase quite a lot. Now, it's no surprises here that operating income in this case loss, direct to consumer, that's where the big hit happens. So again, announcing this dividend before Disney Plus is even profitable, to me just doesn't make sense. Now, when we talk about Disney Plus and how monetizable it is right now, we obviously have to look at the subscriber base and then the average monthly revenue per subscriber. So first of all, total Disney Plus actually decreased 1%. So basically 2.4 million subscribers are gone. Remember when this happened to Netflix, when they, well, didn't grow anymore, they lost, well, it was the end of the world, right? Now, where did they lose? The ones that aren't really that monetizable. Disney Plus and Hotstar, that's down 6% year over year. To me, this really shouldn't really hurt the business that much because as you will see right here, Disney Plus and Hotstar, although it increased 28% year over year, the pricing there, it's still 74 cents. So really, you shouldn't sound the alarm bells, as they say. Now, when it comes to ESPN Plus, that grew 2%. Hulu SVOD only 2% as well. Live TV SVOD 2%. So overall total Hulu grew 2%. That's fine. Now, these segments here are, well, way better monetized. As you can see, ESPN Plus is up 14% year over year to $5.53. Hulu, both of them are just up 2% and 1%, but you can obviously see the big increase here in the average monthly revenue per user, right? Live TV plus SVOD, just under $88. Now, with regards to all the other things here, domestic Disney Plus, international Disney Plus core, all of those increased from 2 to 4% year over year. Now, to me, if you want to go and attract more subscribers, of course, reducing prices is one way to do it. But on the other hand, if you're trying to be profitable in, let's say, just under 2 years, well, I don't really see how this is going to happen when, first of all, the segment where you're growing, 28%, is the one that is barely monetized, right? 74 cents. The other segments that, if you go to competitors like Netflix, which have monetized their users quite well, those segments are down year over year. So, I mean, to me, it just doesn't make any sense. And this is a big issue with regards to the Disney thesis right now, because Disney Plus is going to be a big part of your investment if you go and buy Disney shares. Now, just looking at the subscribers, of course, with Netflix, we've seen the same thing. This might just be a bump on the road. They lost once 2.4 million subscribers. Maybe they'll get them back throughout 2023. It can happen, but you also need to monetize those users. Since the majority of the users that you lost aren't that monetizable, where are you going to get those, well, user dollars? Because they did say during the call that they are going to look for quality instead of quantity. We've seen that with PayPal as well, right? They reduced their guidance for the amount of monthly active users or whatnot because they went for quality instead of quantity. It makes no sense to go after a user that just makes one transaction when you can go after a better user that, well, transacts maybe daily or weekly. Of course, you'll get less of those, but it's more valuable for the business. And the same thing here should be said and could be said for Disney's plans if it wants to be profitable when it comes to Disney Plus. Go after the big ticket spender, let's say, which is usually Europe, United States, and Canada, because you can monetize them much better. Of course, the ad-supported tier should help, but they said don't expect any big changes to the balance sheet, to the bottom line until, let's say, the end of this year. Now, one last thing with regards to the parks here, guest spending growth was due to an increase in average per capita ticket revenue driven by Genie Plus and Lightning Lane, which were introduced in the prior year quarter. We've talked about this when we went over the Nelson Peltz presentation. If you haven't watched that video, it's going to be in the top right corner. But basically, what he said is true. It's true, your average per capita ticket has been increasing, but at the same time, you're phasing out a huge part of your fan base because a lot of people, well, can't afford to spend that much to go with their entire family to a park. It can't happen. So of course, in the short term, this works. This works, as we can see in this quarter, right? It helps to push up, let's say, revenues and in this case, income as well. So it helps to maybe ease the pain in the short term. But in the longer term, if you continue to do this, if you continue to phase out your core fan base, this is obviously going to hurt your business. Maybe right now it works, but if you continue to do this for the quarters to come, of course they did say they're working on it, but it's still very, very expensive currently. Demand is still sky high, but how long will this last? And now truly the last thing before we conclude this video, a quote here from Rob Iger at the start of this report. We believe the work we are doing to reshape our company around creativity while reducing expenses, this is going to be crucial, not surprising, we've heard this 1,000 times already this earnings season, will lead to sustained growth and profitability of our streaming business, better position us to weather future disruption and global economic challenges, and deliver value for our shareholders. Introducing a dividend while also saying reducing expenses and sustaining growth and profitability, to me, is a bit conflicting, let's say. Use the money from the dividends. I've said the same thing with Intel. Use that money, well, to try and make your business more profitable and to grow it at the same time. Nobody really cares about dividend payouts right now when it comes to Disney, especially not if it's going to be less than the one they had before. Try and make Disney Plus as attractive as possible, as profitable as possible as well, and then after that, announce a dividend. So with that, I'll conclude this video. Of course, on paper, this quarter is better than what most feared, but to me, it's still a long way to go when it comes to the Disney story for them to come back on top. Of course, do share your thoughts down in the comments below. And again, if you want more live streams with earnings call, let me know in the comments as well. If you enjoyed this type of video, give it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.